This is like $350 in 10 minutes. There are some people listening to this that don't make $350 in a week. There are some people listening to this that don't make $350 in a month. And this is in 10 minutes. All right. This is like $250, but this is in the same hour. Play one, play two. Crazy. The most powerful event. It is not the only event, I want you to understand. And while you might not be able to make a living every single day with just this one event, I will tell you that it is amongst one of the most powerful events that I've been trading with over the past 3 decades of my life. And I'm going to share it with you today. Now, this tactic is what I call the 180. I call it the 180 because it is designed around a concept of turning the market around in a 180-degree direction. Now, I know some of you are looking at this and you speak Spanish or you speak Portuguese. This slide happens to be in English, but don't worry about that. I'm going to explain it to you. You don't have to read the words. Now, there are 2 types of 180s. There's the bull 180 or the positive 180, the 180 that we buy. This is the bull 180. And then there, of course, is the bear 180. This is the negative 180. This is the 180 that we sell or we short with the idea of profiting on the downside. The bull 180, all right, the bull 180 has great odds, means that your stock or whatever you're looking at has great odds of moving up from here. Your bear 180 is an indication that your stock or whatever you're looking at has great odds of moving down from here. Now, I have found that teaching a concept from the buy side is far more understandable than teaching it from the short side or the sell side. So let's start off with the bull 180. The first criteria of a bull 180 is that the stock that you're looking at displays a fat red bar. This bar here, a fat red bar. Now, I call this an elephant bar. We call these elephant bars. What's a fat red elephant bar? It is a bar that is relatively tall from top to bottom. It can have, the bar is mostly the color red. It can have some wicks at the top or the bottom, but the vast majority of the bar's range is red. There's a fat, chunky piece of red that makes up the bar. It is not a bar like this. Let me show you. This is not the bar we're looking for. You see how this bar has some red, but the bar's range from top to bottom is not mostly red. It is only a small portion of the bar's range from high to low is red. This is not what we're looking for. We're looking for a truly solid bar that is mostly red. If it has some excess on the outside of its red, that's fine, but not much. That's what we're looking for. We're looking for fat red, solid red. Now, this fat red bar is immediately wiped out by an even fatter, longer green bar. Now, this is key, traders. This is the 180-degree turn. This is the 180-degree switch. This is the green immediately overpowering the red by superseding the red's high. Now, this immediate turn is the key to the Bull 180's power. Now, I want you to note that in my image, there is no additional red after the first red. So look, there's no additional red down here. It's just the red stops and green immediately begins the next bar, and green wipes out the entire range of the red bar. So in essence, green is wiping out this portion of red, then wipes out more. As the green climbs, it's wiping out more of the red and more of the red and more of the red and more of the red. And when it wipes out all of the red, boom, that is where I want you to put money into the stock. We put money into the stock when green immediately wipes out a fat red bar. Now remember this. I'm going to repeat this hundreds of times. When green wipes out, immediately wipes out a fat red bar, boom, we enter as soon as green supersedes the high. Now, this green bar does not have to finish. You buy into this bar while this bar is still alive, while this bar is still moving. All you're doing is waiting for the green to surpass the high of the red bar by 1 penny. As soon as it does that, boom, we want to put money into the stock. Now, not 100% of these things are going to work. So just in case this one doesn't work, we're going to place our protection 1 penny under the green. We're going to buy 1 penny above the high of red in the green bar. We're going to place our protection 1 penny below the low of the green bar, which means that we're only going to risk the 1 green bar. And if the market eliminates this green bar, boom, we're out 1 penny under the low. We risk only the size of 1 green bar. We do not risk 2 green bars. We do not risk 3 green bars. We only risk 1 green bar. I need you to understand this. So this is the Bull 180 in a nutshell. We're waiting for our stock to demonstrate a fat red bar, criteria 1. Criteria 2, there can't be additional red after the fat red bar. No more red after the fat red bar. Criteria 3, a green bar immediately wipes out all of the red bar. Criteria 4, boom, we buy into the green bar 1 penny above the high of the fat red bar. Boom. Criteria 5, we place a protective stop 1 penny below the low of the green bar. We only risk 1 bar. That is the Bull 180. Now, let's move on to show you very quickly the Bear 180. The Bear 180 is just the opposite. The first bar that you have with the Bear 180 is a fat green bar. Now, fat green bars tend to lead to more green, but when they don't, traders, when fat green produces no more green is produced. And immediately, a fat red bar, an even fatter red bar, wipes out all of the green. Boom! We put money into the fat red bar 1 penny under the low of the green bar. Just in case it doesn't work, we place a protective stop 1 penny above the high of the fat red bar. So our risk is the size of the red bar. We risk 1 red bar. We don't risk 2 red bars. We don't risk 3 red bars. We risk 1 red bar. So the bear 180 is just the opposite. A fat green bar, criteria 1. No additional green after the fat green bar. No more green. Criteria 2. Criteria 3. A fat red bar wipes out all of the green. Criteria 4, we put money into the stock 1 penny below the low of the green bar. The red bar does not have to stop trading. We enter the red bar when the red bar is still moving, still alive. Next criteria, we place a protective stop 1 penny above the high of the red bar. And so, yes, for those of you who are not aware of this, we can profit from the market on both sides, right? We can benefit traders from the market moving up, and we can also benefit when the market moves down. I enjoy playing the market down more than up. Why? Because down markets produce moves harder and faster, which means that down markets produce oftentimes big money, and big money faster than up markets produce big money. So up markets produce big money too, but not as fast. Down markets produce big money faster. And so I prefer to play the market down. I play the market both. I play what the market gives me. If the market gives me a bull 180, I play long. Boom. If the market gives me a bear 180, I really play that one. All right. I love playing the market down. So we as traders, we're not afraid of up markets or down markets. In fact, we pray for down markets. Okay. I want that to be clear. Let's move on to what we need. Now that you understand the tactic, what exactly do we need to turn this into money for ourselves? Let's talk about that next. Let's take a look at this chart. We're looking at a 5-minute chart here, right? This is a company called Rig. It's an oil company, and it's from the past, but it doesn't matter. This is an old chart, but it doesn't matter. I'm going to teach you based from this chart a few things. Number 1, every bar represents 5 minutes of trading. So we can see that the first bar, this dashed line, represents the beginning of the day. So the first bar of the day, the first 5-minute bar of the day, this is 5 minutes. This is 10 minutes, 15, 20, 25, and all throughout the day. All right. Now, I want you to take a look at this 5-minute chart. Notice that we have a 20-period moving average here. That's the blue line. The green line is actually an 8-period moving average, guys, just in case you're curious about that. We use the 8 too, but we're not going to talk about the 8 today so much. But just to give you a quick glance, we ride profits out with the 8 a lot of times. So we just track that 8 and ride the move out. And as long as the stock does not break that 8, boom, we stay with it, okay? But that's how we use the 8, but that's a different topic, okay? That's a different part of the training. Today, we're talking specifically about the bull and bear 180, and we're going to bring in the 20-period moving average and the 200. Now, I want you to notice that the first 2 bars of the morning produce the very bull 180 I'm teaching you to take advantage of. A fat red bar is bar number 1. Now, in most cases, a fat red bar does produce more red. All right. Now, this could have produced more red, but in this case, it didn't. It produced not a single ounce of additional red after the fat red bar, and immediately an even fatter, more powerful green bar, boom, broke above the high of the red bar. And this, boom, is where I want traders putting their money into the play. Now, if you have $50,000 of my capital, I always suggest that you take half of it. So you take $25,000 and you put it into the initial play right there. Boom, you're going to risk half of the account on the play. So you're going to put $25,000 into the stock right there. Boom, you're going to protect yourself 1 penny under the low. So this becomes your stop out point. All right. And as you can see, over a 5, 10, 15-minute period, we have a nice move to the upside. All right. There are some traders that ride this out as long as they, as the stock does not break the stop, and they can do that. But right now, I want you to just be able to identify the bull 180. Now, there's something I need to also bring your awareness to. I want you to notice where the bull 180 is happening in relationship to the 20-period moving average. Notice that the bull 180 is actually on the 20-period moving average. So there are very unique events that happen at the 20 or on it. It doesn't have to be on it, but as long as it's near it and it becomes meaningful. Look at your baby bull 180 here. So there are regular bull 180s, and then there's the baby bull 180s too, which I like. They're not as powerful as the mama and papa bull 180s, but the baby bull 180s can get their mojo on as well. Now, notice where both bull 180s occur near that 20-period moving average. You see it? Near or on it. Look, near or on it. Now, remember how you play this. In both cases, you're going to buy this bar. This green bar doesn't have to finish trading. That might be 3 minutes into the 5-minute bar. That might be 4 minutes into the 5-minute bar, and there's another 1 minute left. It doesn't matter. You don't wait for the green to finish. You just buy the green bar. You put $25,000 into the green bar as soon as it crosses the high of the red bar. Boom. And you make sure that if this doesn't work, you're out 1 penny under that green bar. We're going to risk this for the possibility of this and maybe even this. All right. Now, remember, even on the baby ones, boom. Now, what I like about the baby ones is that your risk is even smaller. Look at what you're risking. Your stop is under the little baby fat green bar. And look at the potential gain that you made compared to the potential loss. Now, look at the loss. I'm gonna accentuate this for you. Look at your risk. And look at that gain that occurred. Now, all of them will be like this, but wow. Now, my question to you is, how many of these fit inside of here? You can lose 3, 4, 5 times and win once and make a tremendous amount of money. It's all about keeping your risk small in comparison to your potential gain. All right. Now, remember how I told you we use the 8-period moving average. We can ride this gain out. Once it gets above that 8, we're like, oh, wait a minute. Let's see how far this 8-period moving average takes me. And you just waiting with the 8, riding with the 8, riding with that 8, riding with that 8. And you're still in the play making money. Wow. All right. So what's my space concept? No space. So here is no space from the 20. No space from the 20. No space. Near the 20. Near the 20. Okay? Now, let's move on. I got to show you others. Here is your 20-period moving average again. All right, in this case, I have them both red, but 20-period moving average and the 200-period moving average. Now, look carefully. I want you to find the bear 180. I'll give you a minute here. I'm going to sip some coffee. You find the bear. Start from here and just move along and find the bear. Find that fat green bar that's immediately wiped out by a fat red bar. Do you see it? Can you identify it? Have you got this down enough right now after only about 40 minutes of talking to you? Can you look at this chart and boom, find the money? That's what I'm looking for. I'm looking for traders who can look at a chart and find the money. Oliver, I found the money. I'm looking for traders who can find the money, sort of like find the money in a few seconds. Find the money, traders. There it is. Boom. There's the money. Now, notice that the bear 180 is happening near the 20. It's not touching. It doesn't have to touch, but it's near it. And that's beautiful. When this bull or bear 180 happens near the 20-period moving average, wow, it's usually powerful. Now, I told you how a lot of times the traders ride out the play. And remember I told you we ride out the play with the 8, but sometimes we ride out the play with the 20. So boom, here's your, remember how you play the bear? You enter 1 penny under the green, boom. How much do you put into that bar right there? $25,000. We don't play little. Some traders come to me and say, some guys come to me and say, but Oliver, can I put 5,000? Can I put 5,000 in? Can I put 5? No. We're not babies. We're not here to play like babies. I want aggressive traders. We're going to put, boom, $25,000 into this bad boy. I want to make money. I'm not talking about making change, guys. I don't want to make change. I want to make money. All right? It's my capital. I'm risking the capital. I'm putting it in your hands. Let's just play bold. All right? Sometimes I'm going to have you put all of it in. Just not on the bull and bear 180. Why would I not have you put all of it into this play? Think about this, guys. Why? Why is that probably not a good idea with this tactic? I have tactics that you put all of it in. But this one, we're going to put half in. Why? That's right, because the bar is big. Like, guys, when we lose, let's go back to the chart, right? When we lose with this, if we lose, we're going to lose the size of that red bar. All right, we got to suck it up. It's going to happen sometimes. But so we don't want to risk the whole, but on a little bar play, maybe we risk the whole amount. You understand? That's very different. But a big bar play, we're going to risk half. On a little bar play, we can potentially risk it all. Why not? The risk is small. I've never been a timid trader. I've been around timid traders. They never get to a place of really ever making big money because Starting the game as a timid trader gets in your DNA almost, and it's something hard to break out of. I've been around and have actually worked with timid traders that are good. They never make the big money because of their timid. They're consistent, but they can't take it to the. So I don't even start traders off trading timidly. We play big. We play sizable. Okay. And what makes this easier for a lot of my traders to do is that it's not their capital. It's different when you're utilizing your capital and you need this money to pay the rent next month, or this is the savings for your kid going to college in the next 2 years. You can't afford to lose that. All right. When we get rid of all of those concerns, or my God, Oliver, my wife doesn't know that I'm trading. If I lose this, she's going to kill me. This is our life savings. No, none of that nonsense. All right. I put the money in. All right. I put the money in, and we're going to risk my capital. So now you can not trade the markets boldly without being afraid. And if you lose it, as long as you lose using my tactics and approach, okay, I accept that. I accept loss. I can accept loss. I'm a big boy. Here's another chart. This is Facebook, guys. It's old, though. You know, Facebook is not $111 now. So this is old, but we're going to come to things that are recent. I'm just teaching you the concept. Now, guys, I want you, this is one day. We're looking at a 2-minute chart here now. See, 2 minutes. Now, every bar represents 2 minutes, 2 minutes, 4 minutes. This is the beginning of the day. All right, on this day, this is March 8th. Okay. Now, I want you to go from the beginning of the day and just, you tell me, keep going. When do you see a bull 180? Do you see it? You see it coming? You see it coming? Do you see it? Do you see it? Boom! I love that. There's your bull 180. Fat, relatively fat red bar. See, this could have been one. It's just the green didn't make it. This could have been one. The green didn't make it. All right. But this one, the green did make it. Boom! 25,000 in. Stop under the green. This is your risk. This is your potential gain. Now, there are a couple things. There's something I want you to note here. Well, before I do that, now I want you to, from this bull 180, I want you to go, keep going, and you tell me when you detect a baby bull 180. Goo gaga. The baby. Oh, tan lindas. How cute. Where's the baby? Where's the baby? Where's a baby? Boom. But remember, there's the full size ones, right? And then there's the baby ones. We can't ignore the baby ones. Now, there's something I have to explain to you with this. This chart is very important because the full size one happens at one location. The baby happens at another location, and both these locations are critical for our accuracy with this tactic. Let's go back to these locations, okay? The baby one happens where I told you is great. Right at or on the 20-period moving average. This is the 20, all right? Now, this is 2 minutes, guys. So in 2, 4, 6, 8, 10 minutes, you've got, what is this? This is almost, like, let's say if you did like, I don't know, this is like $350 in 10 minutes. There are some people listening to this that don't make $350 in a week. There are some people listening to this that don't make $350 in a month. And this is in 10 minutes. All right. This is like $250. But this is in the same hour. Play 1, play 2. Crazy. Anyway. All right. So this one is at a new location I want to teach you. It's away from the 20. So you got this one at or near the 20, and this one away from the 20. Oh, I like them both. You give me away from the 20. You see, here's the thing, guys. Stocks can get away from the 20. They can't stay away. You see? They can get away, but they can't stay away. You see, they have to always snap back to the 20. All right. So we get away. The bull 180 tells me, okay, it's time to snap back. All right. We get near. It tells me it's time to move away. So this is very beautiful to understand. When you are away, the bull 180 says it's time to snap back to the 20. When you are near, the bull 180 tells you it's time to move away from the 20. Wow. One location tells us it's time to snap back. The other location tells us it's time to move away. We put these things together, guys. The regular bull 180 and the baby bull 180. So two. And the two locations away from the 20 and near the 20. All you need are these four things. The regular bull 180 and the baby bull 180. And the two locations away from the 20 and near the 20. Now you know where to get in. Look at how much you know already. Boom. You know how much to put in, 25K. You know where to protect yourself. Boom. Boom, 25K. And if you are away, try to at least get back to the 20 before you take profits. If you are near, try to get away from the 20 before you take profits. Did you hear that? If you are away, try to get back to the 20 before you take profits. If you are near, try to get away from the 20 before you take profits. It's not rocket science, traders. It's trading. You know what's interesting is that trading comes across as being this truly complex, confusing thing, and it's really not. If you really think about it, trading is basic and it's simple, if not outright primitive. Do you understand? Why am I saying it's primitive? Because it only has three things: up, down, sideways. That's it. It doesn't have the capabilities of the human body. Like right now, about 6 billion processes just went off in that few seconds. That's crazy. That's complex. That is sophisticated. That is not simple. The market, there's green bars and red bars, boys and girls. There's the 20-period moving average and the 200 moving average, boys and girls. There's near the 20 and away from the 20, boys and girls. There's regular bull and bear 180 and baby bull and bear 180. There's buy above the red bar, protect under the green. I mean, come on. What I'm explaining to you is complex. Really? Guys, it's freaking colors and lines. It's up and down. It's near and far. That's all trading is. Red bars and green bars, 20 and 200, right? Up and down, above and below. I mean, these are kindergarten concepts, which is proof that anyone can do this. So why is it that so many people don't or can't? They can't bring themselves to get out when it doesn't work. That's like 80% of the problem. There are other parts of the problem, like they see it and can't do it. Like I see it, but I'm nervous and they can't do it. I can't help you there. Like all I can do is give you the money, but you have to do it. I don't do it for you. You have to do it. And if you're afraid to do it, I don't know what to do. It's already not your risk. So I can't help a person that's scared. I can't do, I don't know. I'm not a psychiatrist. I don't know how to do that. But the main problem is when it doesn't work, you gotta end the game. When it doesn't work, you gotta fire your stock. You're fired. Remember, your responsibility is just to protect the account, protect the money. The stock has to move. You don't move the stock, right? And so a lot of people come to me, Oliver, what? You know what? This seems so basic and clear. Why is it that so many people fail? Because they don't stop the game when they're supposed to stop the game. That's really it. It's that simple. If you can become a professional stopper, if you can become a professional fire, be like Donald Trump when he was on The Apprentice, you're fired. If you can do that, do you understand? You can make it in this business. All you need. Now, another reason most people don't make it is because they're playing with baby money. All right, baby Bull and Bear 180s are fine, but baby money, that you're not going to make it. You can have all the skill in the world with baby money and get knocked around. You're just not going to, it's not going to happen. Not going to happen. All right. You're going to be bullied, outmaneuvered, dominated. You're going to be crushed. So you need the proper amount of capital. So a lot of failure is connected to just not having the right amount of money. In fact, most businesses throughout the world fail for being undercapitalized. Trading is no different. They're going to they're showing up to a gunfight with a little tiny knife. And you think you're going to win a gunfight with a little tiny knife. Let me pull out my little knife here. If you think you're going to win a gunfight with your little tiny knife, it's not going to happen. Right? So a lot of people fail because they got the knife against the gun approach. But even if they have the right amount of capital, they fail because they don't fire when they're supposed to fire.